Awesome. All right, today was so fun. Super, super big gainers. And it was just phenomenal. Usually you don't see like 200% gainers, 200, 100% gainers, 150% gainers. They were like three or four stocks today that just blew it out of the water. Which is super, super awesome. This is like kind of rare to see so much growth. And there was like four of them today, which was insanely cool. And I didn't make day trades, right? So I was looking at like the biggest gainer of the day, which is the ADAP, and when I found them, they were like 250% up, 300% up. I mean, it was massive. And the trade, I mean, it was just an absolutely phenomenal position. They had this pre-market gain, and then they broke like over the VWAP, and they exploded. They basically doubled in the first like 5 minutes trading, which is really, really, really good. And then after that, they kind of tread down, tread down, tread down. And then they came back up and they formed this ABCD setup, right? Which is really, 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 really awesome. And they went to like $5, 550. So a phenomenal, phenomenal trade for the day. And then this one thing happened after I was looking. This is basically, you look at like all the really, really big stocks that are up a whole lot, and the objective, there's a lot of them, right? So even if you're looking at like six or seven, especially if you don't have day trades, like you can usually only take on like one solid like weekly swing position, just because like you're holding this overnight, so it's gonna have high risk. So you need to have really, really, really good setups. So check this out, okay? The price went up a whole bunch, and then it went down, and then it went up a whole bunch in the ABCD setup. But then it formed a head and shoulders setup around noon, and I mean, it worked out really, really, really well. It was a very faint head and shoulder setup, but you had like your first shoulder, and then you had your head, and you had your second shoulder. And so, like, you guys know, like, if you use the head and shoulder setup, you take like the height of the entire thing, which was, for a $5 stock, it was about $1. And then you subtract that from the bottom, which is about 460, and you get your target of about 360 or so. And it just works really, really, really well. And so what I decided to do is you can trade, puts, and even if you don't have day trades, you can trade like the weekly puts that expire at the end of the week. And if you do that, you should do really, 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 really well, just because like you can still hold it, but without having to sell it on the same day if it's got a good setup. So the thing that's important if you do something like this, like you've got to go over to like Yahoo Finance and look at what the news is for the company. So especially like any options positions you're gonna do, it's really critical to understand like what news is influencing it. If you're gonna do very, very short term trading on like 9 to noon stocks, not with bigger stocks, it doesn't matter, it's all technicals, but with these guys, it's really important to think like what actually made them go up 300% today, 200% today. And what it was is they changed some leadership, and they announced some new partners, and it was like all this business growth stuff. It wasn't something sort of weaker like earnings. It wasn't something that didn't really, it wasn't as significant like just a bad press report. And this is important because for this stock, if you look at it historically, it basically, it's very, very rare, if you look at the daily chart, has had just this such a huge, 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 huge spike before. It's very kind of a normal thing for this stock. And so sometimes you'll see they have huge price spikes on the daily, and then they come back down a whole bunch. But for this one, I mean, it has never really had this big of a growth spur in one day before. And so you can kind of tell that it's probably going to retrace at least back down on the daily chart towards the VWAP, because its old price is always going to want to come down towards the VWAP, especially after like 1 o'clock, 2 o'clock. And that's exactly where this trade entry was. It was like 1, 2. And you get in and you buy puts and you go short. And so I would probably sell these tomorrow, or hold them till Friday. I don't know. I'm not in the position. I'm gonna tell you why I'm not in the position. So when I was looking at it like right here, it right at the end of the head and shoulder setup and at the start of the downtrend afterwards, what happened is the options for the end of this week, they were at about 85 cents and $1 on the bid and on the ask for the $5 puts, which those are the ones that make sense to buy, because if you're going to hold these till Friday, it's pretty unlikely that it'll go, the price is up really, really high at like $5, $4. It's pretty unlikely it'll go to 250. It could. But if you buy the $5 puts, you're going to be a lot safer, especially considering that the $5 price level was where the shoulder line was. And so what you would do is you set a stop loss of this trade at like 550, and if it goes to 550, you sell the options at a loss, and that's that. But your upside here, I mean, it's so crazy. So what I did is I bid 85 cents, 86 cents, 86 cents, and then it didn't get filled at about 125. And so I bid another 4 cents. I bid 90 cents at about 133, and then I had to go to a meeting, and I was like coming back later like, oh, did my order get executed? And it totally didn't. And I'll tell you why it didn't, because the bid was at about 85 cents. The bid was at about 90 cents. And the ask was at about $1.05. And the thing with options is, like, usually with stocks, you can gain the bid and the ask, buy the bid and sell the ask, and do really, 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 really well. And, like, that's a core principle, right? Is you save a ton of money doing that, and you make a lot more money. But with options, it's difficult because, there's so much less volume that you really kind of have to you need to pay a little bit of a premium if you want to actually get filled before the price moves. Like with these options were up 535% today, but the volume on it was still pretty low. You can look at it on the app and you can know, like, oh, okay, it might look like a giant move, but in reality, there's probably, I'd say, today on this stock, ADAP, there were 56 million shares traded. So for a $5, $4 stock, that's about $200 million, which is it's pretty solid, especially for a stock that has a market cap of only approximately 400 million. It's about a tenth of their market cap, and it's about half of their tradable shares. I mean, it's a phenomenal trade. I just can't say enough good things about the stock. It was awesome stuff today. But the options that expire on Friday, at least the $5 puts, like today, the volume on those was only about 1,000 contracts, which represents about, 1,000 times 100 is 100,000 shares, or about $400,000. So you've got significantly less. I mean, 400,000 over 200 million, 400 over 200 million. I mean, that you're looking at like less than 0.5%, less than 0.25, less than 0.25%, 0.002 of all the shares traded today were traded in this options contract, which is very, 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 very small. There are only 1,000 contracts traded, and most of them are about 25 size each. And so you do the math on that, 1,000 over 25, and you realize there are maybe only 40, 50, 60 transactions that actually occurred at this options contracts. And so, like, for you to get in, you've got to pay a little bit of a premium, sometimes even buy the ask. And I wouldn't say like buy the ask entirely, but if the bid's at like 80 cents and the ask is at $1.05, like it makes sense to pay 95 cents, to pay $1 and get filled on that. And here's why, okay? See, I bid twice when the price was consolidating and I was trying to get in, and I didn't get filled because I was at the top of the level too, but I wasn't paying enough to actually convince somebody to sell it to me until and I knew the value was going to go up because it's a really good setup, and so I didn't get filled for about that's like 10-15 minutes of trying to get filled. And this is why it's really critical that like you do live trading instead of pretending to do things on paper, because when you do it live, you realize like crap, you don't just get filled instantly. Like you have to actually adapt to the market conditions. And so like it makes so much sense to just pay, a 10% premium if if this contract right now, the price is at what, $3.75. So that means the inherent value of this put is about $1.25. And you can get that price target just based on the ABCD setup. And so it makes more sense to pay 10 cents more if you know that over the next couple of days. Obviously, it's also got time value. It could go to $3 and then you double your money, right? Right now that the market's closed, now that it's gone down a whole bunch, the bid is at 105 and the ask is at 150 and last transaction's at 130. So even if I quote unquote overpaid by 10 or 15%, I still would have made 30% on the trade. And I mean, you see this in so many companies where, especially with sort of these lower volume stocks, or these 9 to noon stocks, like they're gonna have lower volume on the options, and it's just a matter of fact, and it applies really to any kind of investment you look at. I know I love Shopify. Their options are just, oh my god, so phenomenal to trade on an intraday basis, like on the same week. Like you short that stuff at the VWAP cross, it just works really well because it's just insanely cool. But same exact thing here. The volume on these options is only like 640 contracts, 700 contracts, which is only 700, 7,000, 70,000 shares on a stock that, you know, is frankly being traded at approximately, give or take, you know, 2 million shares a day. That's like minuscule, and the reason why is because basically all of the volume in options is being split up between different expiration dates. All of the volume in options is being split up between different strike prices. This this small stock only has a couple of strike prices, but if you look at bigger stocks and you look at all of the strike prices, there's a ton. There's like 100 of them for just this one expiration date, and there's like 15 of those that are tradable right now in the span of, you know, a couple of months, a couple of days, a couple of years. And so you got to understand that there are a lot more people trading the actual stock than trading the options, and the people that are trading the options, which are, you know, the people that are going to make more money if they know what the hell they're doing, they're being split up, right? So it's not just everyone buys one thing. It's split up between like longer term investors buying longer term options, or short term investors buying short term options, and then it's further split up by people buying in the money versus out of the money, just based off of their risk tolerance and how much they're willing to risk. Like if someone's going to buy the 2.5, they might think the stock's going to freaking tumble, and they might bid or risk, you know, a tenth of the amount but have 15 times the upside. And so that's why it's really, 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 really critical that when you're trading options, you take a second to think. First of all, look at the volume. It's difficult to see time of sales, but if you look, you know, at the Thinkorswim app, in the Thinkorswim app, you can pull up any options contract and then just click view quote details after you hold down on the price, and you can see the actual volume intraday. And you can see the actual movement of the price intraday, which is really, 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 really powerful, because you want to understand how much volume you're dealing with. If you're dealing with 1% of the total stock volume, that's really, really good. But if you're dealing with like 0.2%, that's really not that great. And if there's maybe one transaction happening every 15 minutes, you know, at this stock, there was like one transaction for, I'd say, every minute, you know? And, you know, a couple of times you have a peak where it spikes up. You have maybe a couple more contracts getting traded. But in reality, you know, a lot of times with, especially even with Shopify, I mean, they're a massive company, and probably 90% of the candlesticks on this one call options, one put option, are traded in very, 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 very low amounts of volume. It's only 1 or 2 or 3 or 4 contracts. And the reason why is because most people are bidding really low on the ask, or most people are bidding or trying to sell really high on the ask, and bidding really low on the bid, not the ask, my bad. And it's the same thing with any other stock. Like, you've got to sort of increase the premium you're going to pay so you can overcome the illiquidity challenges, if you know, because the options are going to move so much faster than the stock. So if you know that you're right, and you know that you have that profit potential, like, all you have to do is get in, and as soon as you do that, like, you're golden, right? And so that's sort of the key. That's the big mindset shift, is, you know, instead of trying to get really, really, really great deals on options like you should try to do with stocks by buying stocks on the bid, with options you should find really great setups. And, you know, if a stock's going to go from $4 or $5 to $4, I mean, that's a 20% move in the option is only going to be like geometrically scaled in the actual in the underlying stock is going to be geometrically scaled in the option. And so if you know that you can double your money, triple your money, then, you know, in reality, paying an extra 5, an extra 10, maybe even an extra 15%, not to a broker or anything, but just to the market, just by bidding more so that you actually get filled, is a total game changer. And so that's sort of the main principle. That's the main idea, is to not be afraid to pay a little bit more for the same thing if it's going to get you that fill. Because two things, and then we'll finish it up. The first thing is, if the price moves down really quickly, like, you're going to get squeezed out, and the price is going to go above your order anyway, and so you're going to miss out on it anyway. But the second thing is, if you're a little more patient and if the price is going sideways for a little bit, you can totally submit an order at the bid and see if you get filled. The challenge is, a lot of times you won't get filled for 5, 10, 15, 30 minutes. By the time you do have a chance to actually get filled, and there is volume being traded in the option, the price has already moved if you're trading shorter term setups. And if the price has already moved, then you are going to be outpriced. If you were bidding $1 and that was the top of the bid, but now the bid's up to $1.40, you're going to be screwed over and you miss that entire movement. And so a couple things you can do to try to help with this is to scale into the position with maybe half your position size originally at the beginning, maybe a quarter your position size, just a little bit above what everyone else is paying, and then get filled on the quarter and then try to bid a little bit lower if it's possible. Or if you see a really great setup, just get it in and buy near the ask, so that you get filled, unlike all the other people that are trying to get a super great deal, but in reality they're not actually creating any transactions. I'll kind of give you guys this one last little story, and then I think we'll be done for the day. We're in economics today, which we're trading, this online like education thing, and they're looking at trading oranges, and we had like this like fake little school market thing where we'd have buyers and sellers of oranges, and it was like an actual interactive thing, and they were like a level 2. There was a time of sales, you get to set your price, but the thing was there were only like 5 or 6 or 7 people in each of the groups that were actually trading. So you'd have like 4 buyers and 4 sellers max, and in reality there was like maybe 16 transactions that occurred when everybody was supposed to sell like 50 oranges. And the reason why is because of low volume, and people got screwed at bad prices because of low volume. And so it's not optimal to trade low volume, but you have a lot of upside potential when you trade options on any kind of stock. And so it's really critical that you're willing to maybe pay that extra 10-20% on an orange or whatever you're investing in, even if you have to take not even a loss because there's no transactions, very few transactions going on, but even if you have to pay a little bit of a premium over what you see the bid as, if the price of orange, or the price of whatever you're trading, goes up by a factor of 4, then the little tiny change at the beginning doesn't really freaking matter. And it's more important to just be in the position. This trade would have been worth 50% to me if I just paid an extra 5% to get in. And so, I mean, I've had this happen many times, and I'm finally going to make that shift. I'm kind of going to make that change because it needs to happen. You need to be willing to put up more to get more. And so that's the big message today. When you're trading low volume options, put up a little more than the bid, and get a little closer to the ask. Obviously, if the spread is freaking massive, like the spread in the post market is going to be really big. It's like, 50% spread, 45% spread. Like, don't try to do that crap. Maybe go in the middle or something. That's a big spread. You want to see, in the market, when the market's open, it's like a 10 or 15% spread. So you want to see, obviously tighter spreads and more reliable stocks. But, if the option expires in 4 days, then, you can really just get in and let it expire. If it expires in 4 months, then obviously you're going to want to look for a company that's, you want to understand a little bit of the fundamentals a little bit more as you're getting into the trade. And that's really going to be the golden rule. The golden savior is to really just know what you're investing in. And so mostly technical analysis, but also a little bit of fundamentals. And the more long-term you get, the more it gets involved with fundamentals. So that's the big message for today, guys. Hope you got a ton of value out of this training. Go out there, apply it, absolutely crush it. And I will see you guys in the next one. Thank you. Bye.